Welcome back to another recap of last week's news. We have quite a few topics to cover, so let's just get right to it, starting off with GameStop. Just when you thought the GameStop saga was a thing of the past, they surprised investors with their first profitable quarter in over 2 years. With generated revenue around $2.2 billion, GameStop posted a net income of $48.2 million, which was a significant improvement on the $147.5 million net loss just a year prior. In typical GameStop fashion, this news sent the stock price soaring 35%, creating a sense that the meme stock has returned. But here's what's interesting. This latest price surge wasn't really a byproduct of Wall Street bet-style trading, but rather good old business fundamentals. If you take a look at their financial statements, you'll see where the business is improving. They meaningfully reduced their cost of sales and therefore improved their gross margins. They also reduced their administrative costs, resulting in positive operating earnings. And lastly, they've successfully managed their debt obligations and taxes, all leading to that $48.2 million in net income. If GameStop can consistently earn a profit, they'll be in a position where they're less reliant on debt or new stock issuings to fund any future capital investment. And that's a position you want to be in. With the high interest rate environment we're in, any debt you take on is going to come with a hefty price tag. And with stock investors anticipating continued volatility, now is not the best time to be issuing stock. That's partly why we've seen over a 50% decline in IPOs. Speaking of high interest rates, the Federal Reserve announced they'll be hiking the federal funds rate another 25 basis points, bringing the total rate between 4.75 and 5%. This isn't surprising. The rate increase was expected given that the labor market has remained strong and inflation is still elevated well beyond the Fed's target of 2%. But what I certainly wasn't expecting was the Fed's softened tone on future rate hikes. It wasn't too long ago that the Fed was saying their fight against inflation took absolute precedence and a more aggressive approach to interest rates was on the table. Now, it appears the latest events in the banking sector, I'm looking at USVB and Credit Suisse, has the Fed questioning their next course of action. Here's the thing. The Fed has clung to the idea of a soft landing in which they can tame inflation without tanking the red-hot economy that's, in many cases, still recovering from the pandemic. But that's a very difficult thing to achieve when inflation rates are so far off their target. If the Fed pulls back on rates too early, inflation will insist way beyond what's predicted. But if the Fed pushes rates too far, the pressure on financial institutions will bleed into other parts of the economy and will ultimately result in a recession. What you and I have to worry about is how these rate hikes indirectly affect us. When the Fed raises their fund rate, it's more expensive for financial institutions to borrow amongst each other. And when their cost of capital goes up, they have to charge more for the money they lend to consumers like us. So all else equal, expect higher interest rates on credit cards, mortgages, auto loans, and other lines of credit. The labor market is still strong, but that doesn't mean we're not seeing instances of companies cutting labor costs through layoffs. Most of the downsizing has taken place in big tech, and that trend continues with Amazon cutting another 9,000 workers across several different departments. Their reasoning for the cuts was more of the same, reducing costs amid economic uncertainty. The 9,000 job cuts is on top of the already announced 18,000, bringing the total amount of layoffs to 27,000. On a personal level, anytime someone is laid off is a sad, unfortunate thing. That's someone's livelihood, and I hope their transition to a new career is both swift and painless. From an economic perspective, Amazon is still net positive in job positions. Remember that Amazon went on a pandemic hiring spree, growing their workforce by over 800,000 positions. So even with these layoffs, Amazon still employs over 1.5 million workers. Joining Amazon, we saw the consulting firm Accenture announce 19,000 layoffs across their non-billable positions, which really just means administrative and back office roles. Again, they cite cutting costs amid economic uncertainty. And they're not the only big consulting firm leaning out. Both McKinsey and KPMG are expected to reduce their workforce. So big tech may be leading layoffs in numbers, but other industries are certainly tightening their belts. If for whatever reason you're feeling like your job security is at stake, I think a lot of us can resonate with you. These are uncertain times, and there's no way of knowing how deep of a recession we're headed into. if at all. The topic of job security and how to position yourself in a career to insulate yourself from layoffs requires hundreds of videos. So until then, I'll say this. Make sure you have an emergency fund. 3 to 6 months of expenses, in some cases as high as 9, if your position is particularly competitive. Your emergency fund will buy you time while you transition to another job. Time to look, time to apply, and time to interview. And most importantly, you won't make any decisions out of desperation. You'll make better decisions without the stress of how you're going to pay bills. TikTok might be banned in the US. For real this time. TikTok CEO sat before Congress to answer some rather interesting questions about the platform and how it works to provide individual users with tailored experiences. Part of the hearing was pretty reasonable, with questions about TikTok's algorithm, age restrictions, and types of data being stored. But a lot of it was ridiculous, with some politicians even asking how phones use Wi-Fi. The biggest concern for the US government has been a matter of national security. TikTok falls under the ownership umbrella of a Chinese company called ByteDance, and because Chinese enterprises fall under their country's national intelligence law, there's questions about TikTok sharing US user data in cooperation with the Chinese government. As per TikTok CEO, the company is in the process of transferring all US user data to be stored in US-based facilities, and has emphasized that TikTok's data practices are no more invasive than other American-owned social media platforms. But after watching the hearing, it appears government officials aren't buying the idea of a Chinese-owned corporation operating independently from the Chinese government's oversight, whether that's true or not. TikTok being banned would obviously be a huge deal. The platform is incredibly popular with 150 million active users in the US, almost half the population. And amongst those users are content creators and businesses that rely on TikTok to reach their audiences and build their brands. It's not only become an effective way to market, but has also challenged traditional advertising. Let's not forget that TikTok revitalized short-form content and has now forced every other social media platform to integrate a short-form experience of their own. So with TikTok gone, that's one less competitor to push other platforms to improve the user's experience. So should TikTok be banned? I guess we'll have to wait and see. And that's all I have for today's video. If there was another piece of news you'd like to discuss, I invite you to leave it in the comments to get that discussion started. As always, thanks for watching. Until next time, take care of yourself and best of luck.